Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everybody. Welcome to the 20th episode of Carson's Facts versus Feelings. Here we go, Sonu. Ready for takeoff.
Ready for landing?
Houston, we have soft landing. I hope I didn't totally butcher that. Did you know what I was trying to sound like they sound at NASA? How close was I?
That's close. You know, the moment you say Houston, that works, right? So, you know, and we're not landing into the water, by the way. So, like space shuttles used to do.
No,
so.
Exactly. So, guys, we're back. Ryan and Sonu, we're going to talk about why we think the odds of a soft landing have greatly increased. Again, this week we're going to call the podcast Houston, we have soft landing. So we're going to dive into the economic data there. We're also going to take a look at the Fed, right? The Fed had an interest rate decision. Stocks took off initially on that. We're going to dive into what exactly they said. And lastly, why this year, 2023, does not look like 2022. We do not think this is just a bear market bounce like so many people say. And those are, it's a good thing, right? Those are three things we're going to talk about. Now, Sonu, first things first, I heard your kids lost their balloon last week and it caused a lot of trouble around the United States. What in the world was that about?
I need to look around for, where is that balloon? No, it's above South Carolina.
You lost it.
It's in the water. It's it felt so Dr. Strangelovian, the whole thing. I mean, wait, the Chinese are now sending a balloon, that's the way they're going.
My only take is this. I lived in South Carolina for 6 years, so it's pretty cool. South Carolina took care of the balloon problem. But my daughter has TikTok, okay? And I'm sure a lot of listeners' daughters and sons have TikTok, and some advisors even use TikTok. I know that for a fact.
Are you on TikTok?
We're worried about a little balloon. We're worried about a balloon floating around. All right. They're watching us one way or another. I don't want to get too political, but trust me. And this whole TikTok thing, we're not going to get into this, but this whole TikTok thing, I saw Texas looking to ban TikTok. I mean, it is, it's getting to the point of, a big discussion, but we'll probably break that down soon enough. But anyway, I'm glad your kid's balloon is out of the news.
Yes.
Sony, we'll leave it at that.
Imagine what fun it would have been to be the pilot of that F-22 Raptor that shot the Sidewinder missile into the balloon.
Yeah, he'll probably, everybody gets a Netflix show anymore. He'll probably get a Netflix show on what that was like to do that. But anyway, so let's get into it. So again, the idea of a soft landing is much higher than it was. Our friends at Goldman Sachs said 35% chance of recession after the jobs number, which we're going to talk about right now. They lowered it to 25%. We've been in the camp the whole time. It might have been about 25%. We might be saying it's 15% chance of a recession now, about 1 in 6. Let's start with the jobs number. 517,000, almost 3 times more than expected. Likely cemented there's no recession coming anytime soon. You've had a few days to look at it. How strong was that jobs number? What's it mean for the economy, Sony?
I mean, as soon as the number came out, I just chuckled. It was so ridiculously large. I mean, 517,000 jobs in January when everyone is expecting a slowdown to 175,000. And then they revised last year too from 4.5 to 4.8 million. So remember all those recession calls last summer? Well, the economy did even better than we thought it did last year, in terms of job creation. So, and Ryan, the unemployment rate, by the way, which does not get revised, right? That unemployment rate, 3.4%. That's the lowest since 1969, Woodstock, right? And you have to go back to 1953 to get to a lower unemployment rate than that.
Yeah, I said the great philosopher Bryan Adams, the Canadian singer. Remember that famous song, Summer of 69? That the views of just how great things were is a rough situation, but things were a lot better. Guys, that was the last time the unemployment rate was this low, was the summer of 69. I guess May of 69, but close enough for summer. So Sonu, when you look at it though, a lot of these jobs came from leisure hospitality, something you've been talking a lot about. What surprised me, though, let me make sure I read it correctly, IT jobs, so I guess technology jobs, only dropped, I'm saying air quotes here, only 5,000. I'm hearing about all these big layoffs. We've talked about it like 2 or 3 weeks in a row. Where are these layoffs from tech? What's going on there?
I like to think about a difference between gross and net. Like when people talk about
Mhm.
layoffs, they're like, oh, yeah, we're laying off people, right? Well, what's the other side that you don't see? Well, for one thing, a lot of these folks that get let go, they get severance pay for several months. So they're still spending. And a lot of them find
Yeah.
jobs as well. So when you think about, net number of jobs created, that's positive because look, these companies are still hiring, right? Remember, I think a few episodes back, we talked about Boeing hiring 10,000 jobs, 10,000 workers,
Right.
manufacturing, engineering. This morning, I see a BBC report saying, oh, Boeing's laying off 2,000 people from
Mm.
their offices, right? I have no idea what that means. It could mean anyone from VP level people to directors or even, dare I say, janitors, right? It could be anything, right? But, look, you have to look at the net as opposed to the gross and the headlines.
Great point. I remember when Google laid off, I think it was 12,000 people. Hope I'm pretty close in that. I did see 29 of them were masseuses at their home office out in
There you
California.
go.
So, just again, you kind of got to look at what's going on there. The other thing, Sonu, let's kind of, we want to move forward, but final thing on this, hourly wages. They're still going up, but not as much as everybody was worried about. So we're creating 500,000 jobs and hourly wages are slow. Why does that matter to the Fed?
Look, the Fed's theory is basically, look, inflation's high. Why is inflation high? Especially underlying inflation, right? They've talked about core goods. Okay, that's in disinflation. They talk about housing disinflation is in the pipeline. We've talked ad nauseum about,
Mhm.
how that's coming. And so now
Yeah.
they've sliced the inflation basket even more. They're talking about core services X housing, right? Set aside what's in that. It's a big grab bag of stuff, right? All sorts of things in there. Now they're tying that to wage growth. They're saying if wage growth is strong, that category, core services X housing, will be strong as well, right? So they need wage growth to slow down. And
Mhm.
guess what it is? It is slowing down, right? That's a good news. I mean, we get our average hourly earnings every payroll report, but that tends to be noisy. It gets revised. But we also get the employment cost index, right? That's only once a quarter, but that's like the gold standard measure of wage growth. And that's slowing down to about 4%. It's still higher than where it was pre-crisis, but look, 4% is not, it's not 8%, it's not 6%. That's where it was last year. And that's what worried the Fed, and they got really aggressive, and now it's back to 4%. And you have to think, if inflation's running at 2%, wage growth is running at 4%, that means real incomes are rising, Ryan. I mean, and what do you think
Right.
happens when real incomes are rising? It's good for the economy, it's good for consumption, right?
And you've been saying this for months now that one of the main reasons the Carson Investment Research Team does not expect a recession in 2023 is the consumer strong. And what you just said, real wages are
Right.
rising. And people, I don't know, they seem to be ignoring it or not. I know everyone's focused on the yield curve and some of the things that aren't so great. But the truth is the economy is still strong. And remember, I mentioned last week what MasterCard and Visa, some of these consumer led companies had to say about earnings and the future of the consumer. Spoiler alert or Cliff Note version, it's still strong. Now, you mentioned the ECI, the Employment Cost Index, something I joked. I've done this for, I don't know, 22 years now. I never heard of it until a couple months ago, I'll be honest, until Jerome Powell mentioned it. And then now we're all experts on it. We're all
Yes.
watching it, like Twitter experts, whatever thing happens that day. We're all experts all of a sudden. But the bottom line, all right, let's get to the bottom line. ECI in the fourth quarter was up only 1%, expected to be up
Right.
1.2%, all right, lower than expected. Been down 3 months in a row. First time since late 2004. Also, we saw the unit labor
Costs.
costs came out. That's in the productivity number. Productivity was really strong also. Unit labor costs up only 1.1% in the fourth quarter versus up
Yeah.
1.5%. Sonu, the bottom line, various three straight core CPIs were really solid. PPI has been coming back. We talk about time to
Hmm.
delivery, prices paid in these regional manufacturing,
Margins. Right.
hard data, soft data. The bottom line is the bottom line is inflation's coming back way more than anybody expected,
Yep,
right?
absolutely. And like when you talk about unit labor costs, right? It's based unit labor costs is how much does it cost a business, in terms of labor to produce one additional good, right? That's coming down, and that's what the Fed is
Yep.
worried about, right? Productivity. This is the other thing. Remember last year when productivity fell quarter over quarter, and there was a huge storm over that.
Huge move.
Yes, and everyone's
Right.
like, "Oh my God, productivity fell." Well, guess what? Last quarter productivity rose 3%. Is the annualized rate. These productivity numbers are going to be volatile, right? It's derived from other things that they measure in the economy, like output and compensation, things like that. How many hours of people are working, things, all of that, right? So they're going to be noisy quarter over quarter, but pull back a little bit, right? Over the last 3 years, 2020 to 2022, productivity is actually running above trend. So over the last decade, productivity grew about 1%. Over the last 3 years, productivity is running about 1.7%. And that's huge. Productivity is a game changer because what is wage growth? Wage growth is productivity plus inflation. Now, if wage growth is running
Mhm.
high and if productivity is running high, you can have low inflation, right? That's then we're back to the late 1990s, right? I think that's a very positive
Yeah,
scenario.
absolutely. So, just a couple other bullet points that happened last week, or major events, I should say, happened last week that increased the odds, in our opinion, of a soft landing. ISM services came in at 55.2 versus right around 50. Bottom line above 50 is expansionary. Do not forget, services are a huge part of the economy. And that comes out to over a 3% annualized GDP. Now, maybe it comes back a little bit, but we saw a big drop in December and we snapped back. So we like that. Factory orders also came in up 1.8%, higher for the last 5 months. Again, just more baby steps in the right direction. I mean, let's put a bow on this. Bottom line, you've talked about this with the pilot before. How do you see the pilot as it pertains to soft landing, hard landing, driving the plane, flying the plane? Where's the pilot right
So
now?
let's pull back, right? Look at the economy. Where is it, right? What's the story? Last quarter, GDP is
Hmm.
growing about 3%. Unemployment matches the lowest we've had in 53 years. Inflation over the last 3 months is running about 2%, thereabouts. Wage growth is running, as we just talked about 4% over the last 3 months. If you look at ECI, which means what? Real incomes are rising. Productivity is jumped to 3% last quarter, but it's above trend, right? Even though last quarter is volatile. Auto sales are going up. Auto production is moving up. Aircraft orders are surging. The dollar is weaker than it was last year. I mean, like forget. I think the pilots, which is the American consumer in this case, is not even looking for a runway at this point. And maybe they're still up in the air. And maybe that's why the Chinese sent the balloon to see what the American economy, what the American consumer is doing, up
Yeah.
60,000 feet above the
Yeah.
ground.
Yeah, they're flying around saying, "Wow, they're out there and they're experiencing life, having some fun." So that's
Yes.
good. By the way, so that's the bottom line. We're going to move forward, but the economy, as we've been saying for a while, does not look like it's headed to a recession. That's been our base case. Other people are coming around to that, which is nice, and we think that's going to continue. Now, speaking of planes, the other night I did see Plane with Gerard Butler. It's
Oh,
as ridiculous as you think. I don't need to get into it too much, but he's on a plane. The plane wrecks on this little island, and there's some mercenaries, and they have to protect the people. And of course, it's Gerard Butler, so it's action and guns and
sure.
things. And I'll just say this: it was amazing. If you like stupid movies with no point whatsoever, just action over the top, I just love anything Gerard Butler does. So that was Plane. You kept talking about planes. I'll give it the Ryan stamp of approval. Also, yesterday I came in, Sonu, you know this. My computer, I've been here like 6 7 months now. My computer just everything stopped, like all my past everything died. My whole computer like
Wow.
stopped working. So for 90 minutes yesterday, thank you to John on our IT team who helped me, and he had to like rebuild everything. I don't know what I did. I said, what in the world did I even do here? I thought I was going to help the whole technology thing by needing a whole new
There you
computer,
go.
but he helped me. It was an interesting start to a Monday, but
It's,
everything's working
it's
now. All
terrifying.
right, Sony, let's go forward. The Fed had another interest rate hike, 25 basis points. That's nicer than the four consecutive 75 basis point hikes we saw last year. I'm going to turn it to you right now. Stocks took off. Stocks rallied like mad on Wednesday and Thursday. Sold off a little on Friday on the jobs number. I think it's just a little seasonal weakness, nothing to be concerned with. Why did stocks like what the Fed said on Wednesday and then follow through on Thursday?
Right. Yeah, that was such an interesting day because, yeah, they raised rates by 25 basis points. And everybody and their mother, dare I say, expected that. Right. And so
I doubt if my mom did. She probably had no idea, but other mothers probably had a clue it was 70 or 25 basis points.
I
So
don't think my wife probably thought about that either, to be honest. She's a mom. But anyway, setting those aside. So,
I'll just jump in real fast. Sorry, real fast. So when I used to do this in an option shop, I did the same. I've done this stuff. I always would go on TV talk about the VIX, the VIX,
mhm.
the VIX, and my wife would always. She had no idea. She's a social worker. She had no clue what I was talking about, and she'll be like, "Hey, how'd the VIX do today?" But it was like a joke. She had no clue what the
Does she
VIX was
still
doing.
ask you that?
Anyway, so it was up or down. Yeah. What's
Does she
that?
still ask you that?
No, not so. Now it's like, what kid has practice and where do we have to be? Oh, we got to be in 3 spots with 2 people. Yeah, let's figure that out. That's kind of what we talk about now. But anyway, I don't know where we were. The Fed.
Fed.
Why did stocks
Fed.
bounce on the
Yeah,
Fed?
so the statement came out and they said, look, on balance, I think it was a little more hawkish because they said, we think ongoing rate increases, so plural, will be necessary to bring inflation back to target, right? The target is 2%.
Mhm.
So stocks actually fell about 1% after that, right? So there's half an hour between
Yeah.
when the statement comes out and the decision comes out and Jerome Powell's press conference, right? The chair of the Federal Reserve. Now, when he came out, he gave a statement, which is pretty much the same thing. Then the first question he gets is from the reporter is like, okay, financial conditions have eased. Are you worried about that?
Mhm.
Right? Does that go against your tight monetary policy stance? And he was like, well, financial conditions actually have tightened over the last year. Right. So he's almost saying, don't look at the near term, look over the last year. Financial conditions
Yep.
have tightened. And that's just kind of true because real interest rates, so interest rates, think about it on Treasury inflation protected securities, that's up. That's up about 200 basis points. That's about 1.5% or so. Mortgage rates have, surged. They're about 6. They went up to 7%. They're back to 6%. But in the process, the Fed's managed to crash housing activity. Right. So, yeah, he's right. Right. But in the near term, financial conditions, you talk about stock market, credit spreads, things like that, all that's eased. And on balance, when he said
Yep.
that, market loved that because that's dovish, right? He's saying, you know what, we are not pushing back on financial conditions anymore, which, Ryan, if you remember back to Jackson Hole, remember what happened? The market fell
Oh, yeah.
3% after his speech because financial conditions had
Even in
eased.
December. In December, he was hawkish,
Yep.
right? And I mean, yes. Right.
And back after that Jackson Hole meeting, I think our very first episode, we talked about Neil Kashkari, the governor of the Minnesota Federal Reserve.
Mhm.
He talked about how he was happy to see the market fall after Powell's speech. They're not quite doing that anymore. And I think that's what, at least the market doesn't think they're pushing back the way they did last year. And that's positive.
Absolutely. We've said before, the 4 most dangerous words, Sir John Templeton, this time is different. I'm going to say maybe some of the 5 most bullish words. During the Q&A, Powell said this: the disinflationary process has started. When he said that, everything took off. Now, here, our friend Tom Lee over at FundStat, FundStrat, Tom does amazing work. Tom counted the Fed, well, Jerome Powell, said the word disinflationary 13 times last
Wow.
Wednesday during that conference. All right. In December, when he was quite hawkish, maybe you could say, maybe he shouldn't have been. He's almost ignoring the inflation data we were talking about repeatedly that was improving. He didn't see it, but he's coming around. He said disinflationary 0 times in December. Unlucky or lucky 13. The bottom line is the Fed is starting to see some of this inflation stuff that we've been talking about for months, and that they have to play the game and make it confusing what they're saying. But when he says this disinflationary 13 times, Sonu, what does that tell you?
It's almost like, just as you said, it's a recognition, right? That the process is started, it's continuing, right? And that's good for everyone.
Yeah. No doubt. I'm just looking at some other notes I made to myself here. Here's let's go this route. I guess according to what I was reading, they opened the door for cuts later this year. We've been saying we didn't buy that at all. Then on Friday, that Strong's job number, we had the 2-year yield up 18 basis points 2 days in a row on Friday, and then follow through on Monday. I think after that strong jobs print, it's kind of confirming there's no cut the rest of this year, right?
Right.
So that was our base case the whole time. What do you think?
I mean, you have to think the other side of saying, the economy, we think the economy can avoid a recession, is that rates will stay higher for longer. That has to be the conclusion, right? Now there is this interesting scenario where if the Fed is focused on, and it's ironic that they're focused on this one number in a sense, core services X housing. If you see disinflation there, we may get to an interesting scenario at the end of the year. We'd be like, wait, the economy is growing. Okay, that's fine. But if there's no inflation, why do we need rates at 4.5%, at 5%? Right now, I don't think we'll get there in June or July, but once we get to November, December, I think that's going to be the question on their minds, assuming you see that disinflation in that little category they're watching right now.
Absolutely. So just yesterday, right, the Fed Fund futures had a July terminal rate of 515, which is actually the highest we've seen so far. So it is a little bit higher than the 475 where rates are now. I've been in the camp that they weren't going to do any more rate hikes. maybe I'm changing my tune just a tad after that strong jobs number. There might be one more, but the bottom line, if we keep seeing strong inflation numbers, this is a good thing. Any final comments on the Fed before we kind of talk about the stock market and wrap things up?
No, I think it's just interesting how the markets come around to the Fed. I mean, you see all these charts of, oh, the Fed is going to be dragged to where the markets are, but we're kind of seeing the opposite. And I think the economy being strong has a big role to play in that.
And I mean, again, congrats to you, because you've been saying that. You were one of the only people I know saying that in October, November, December last year, that the likelihood is to avoid a recession. And we continue to see data that firmly supports that. So before we talk about stocks and kind of why this year doesn't look like last year, even though some people say it is, so I got to admit, so I'm in Ohio now, and it's been colder. The last week, I've had a terrible cough. Luckily, I'm sucking on cough drops repeatedly during this podcast. Just uncontrollable cough. I don't know. I don't remember it being like this. I'm taking all this different medicine, allergy medicine. Nothing seems to work. Do you have any advice for a guy like me who just has horrific allergies apparently right now?
My son is in that kind of situation. Do you try a humidifier at home?
Well, no. Maybe I should do that.
That's a thought.
Okay, that helps.
That's a thought. Practical advice from the Carson Investment Research Team.
Sleeping's about the only way I stop coughing. It feels like, yeah. As someone who goes on TV and presents a lot, I'm like, I can't have this, So anyway, but if everybody's battling some allergies, like over the past week, like the Bengals lost a heartbreaker, all of a sudden I got this terrible cough. Like my life just fell apart in the last 8-9 days. But anyway, it's all relative.
You should get one of those.
So guys, we've got about 5 or 6.
Those mister machines, which just puts that mist out, and will get you.
I think I need one of those when I walk into a room, right? Those the fog machine with the lights, and I walk into a room. Is that what you're talking about?
Anyway. I know. Right. You can put the lights on too. And that's a whole different effect.
Okay, so we're going to try to wrap things up here in the next 5 minutes or so. We've heard a lot. Listen, the S&P's up 17% off the lows in October. S&P was up 17% off the lows in from June last year. We had a big bounce summertime, as I'm trying to say, and then we sold off. Okay, and people are saying this time is just like that. We're going to roll over again. Now, so I've got a couple things. I did a blog on this just recently. But I wanted to talk about a couple things here that I think suggest this doesn't look like back then. First things first, S&P 500 is above the 200-day moving average. Been above it for about 3 weeks now. We haven't seen that before. There is a trend line connecting all of the lows back in 2002. Just connect the dots on the way down. We are above that now. Also, the median stock is actually breaking out and outperforming. We have significantly more 52-week highs now than we had any time last year. Okay, so you see, when you start layering all these different things together, along with the fact that we had a golden cross, everyone. What's a golden cross? And the 50-day goes above the 200-day. Look back in history, there have been 36 of them since 1950. A year later, up about 11% on average for the S&P, median closer to 13, higher 78% of the time a year later. Here's the real important thing, though. This golden cross took place about 13% from all-time highs. I got to thinking, that's a long way away. So I looked, when you're 10% or more away from all-time highs and the golden cross happened, Sonu, a year later, S&P up 15 out of 16 times, up 16% on average. Any one of these by themselves, sure. Take it with a grain of salt. When you start layering all these factors with momentum we've had, with inflation coming back, with all these positives on the technical front, to me, this rally does not look like last year, the 17% rally. Maybe we have a normal February hangover. February's not always that great for stocks. Okay, but I think we're not going to roll over to new lows, and we think the stock market looks good. What has changed for you? Why is 2023 not 2022 in your opinion, Sonu?
I mean, unless the Fed raises rates from, where are they, 4.5% to 8%, I mean, just by that, it's going to be different, right? So everything else we talked about, like, that's conditional on what the economy does, which is why we talk about the economy, right? But the nice thing is, you talk. I think 2 key words, right? Everything you talked about, momentum and breadth. I think that's what I take away from what you just, that blog you wrote was awesome as well. But yeah, momentum and breadth, and you don't want to ignore this stuff, right?
Yeah, I mean, this time a year ago, we were seeing less and less new highs. We were seeing utilities leading, staples leading, drugs and healthcare leading, some of the more defensive areas. We are seeing, now believe me, we did not expect a 25% bear market. It was maybe a warning sign, and I was on record to saying we could have as much as a 15% correction in a midterm year last year, but we did expect stocks to bounce back. Clearly, that didn't happen with the war and the inflation and the aggressive Fed. Certain things happen, right? What's the famous quote by Lou Holtz, right? Life is 10%. How do I make sure I say this correctly here? Life is 10% what happens to you, 90% how you respond to it, right? We can all have these opinions. Things are going to happen, and it's how you respond to it. And bottom line, stocks didn't respond well last year. We get it. But we have a 180, in my opinion, on a lot of these things, and that's a real positive. Now, last thing, Sonu, it's a Super Bowl week. Who do you think is going to win the game? Put you on the spot here.
Oh, goodness. The Eagles?
Okay, Eagles. Yeah, I'm going to go with the Eagles as well. And here's why. And again, do not invest in this. Whatever disclosures we have to have, let's do it. Super Bowl indicator. People love this stuff, so I'll just do it real fast. When the NFC wins for the full year, stock market gains 10%. When the AFC wins, that would be the KFC.
KFC.
Where's my mind? The KC Chiefs. Up about 7% on average. Now, take note. The last 11 times the AFC won the Super Bowl, the stock market didn't gain 10 of them. The only time it was down was in 2011 when stocks were like flat. So lately, AFC's done better. Again, don't invest in this. It's just play stuff. The final one that shocked me, though, I was a Bengal fan. I was like, man, the Bengals lost only by 3 last year. I got this big spreadsheet with all this data. I said, they only lost by 3, and the stock market did terrible. I started looking. When you have a blowout in the Super Bowl by 21 points or more, incredibly, the stock market does a lot better. And actually, I don't have that written down here. But bottom line is when you win in double digits, when you win by at least double digits, the stock market gains like 11% on average. And when you have a single digit Super Bowl win, the stock market only gains 5%, half of that. And those returns even get more when you're up 21 points. Again, don't invest in any of the stuff I just said. It's fun, though. Yes. Bottom line, let's have a fun game. Hopefully, the refs don't make themselves well known. Let's just have 2 teams play each other, and I'm going to say the Eagles as well. Although I will note this: we jokingly said this before. When a Philadelphia team has won the World Series historically, you've had like the financial crash.
Wow.
You've had the Great Depression. You've had some bad times on a Philadelphia baseball team.
Maybe I should change my mind, but does it matter who plays the halftime show?
Who is it? Rihanna? I think it's Rihanna.
I have no idea, but
Yeah, I know. I honestly, I liked last year's halftime show though with Snoop and everybody.
Oh yeah, that was cool.
That was pretty awesome. That was a good one. I thought Bruno Mars. I don't even like Bruno Mars. I shouldn't say that. I have no opinion of Bruno Mars. I thought Bruno Mars was one of the best halftimes of all time.
I like
the energy
Bruno.
And the fun, and he was. I can see you dancing to Bruno. I can see you headbopping to Bruno. Any final comments, Sona, before we close out this week's Facts versus Feelings?
Oh, maybe the Chiefs should win. I don't know, but
got you stumped.
Confused me there.
All right, well,
breadth and momentum. I'll leave you with that. Breadth and momentum.
There we go. Yeah. So again, the soft landing we think is here, right? We think we're going to avoid a recession. We really appreciate everyone joining us for the 20th episode of Carson's Facts versus Feelings with Ryan and Sonu. We'll be back next week talking about everything. But with that, hopefully everyone has a great week. Do not invest in the Super Bowl, winner or loser. Let's make that very clear. But let's hope everyone has a great Super Bowl and a lot of fun watching it. And hopefully just a great game without the refs causing too much trouble. Great game, everybody. We'll see everyone next week. Bye-bye. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Dietrich are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.